Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we are once again joined by Mickey Limmer, who is a real estate agent from Harcourts in Canterbury. And today we're answering a question that's been sent in by a listener. And he's specifically asking about strategies for reviewing your portfolio, the when and the how. And so he's asked here, is it buy and hold forever, or is it buy, review annually, cull the week, or what is it? How do I review my portfolio? They've said, I've got a property that hasn't tracked to plan and I've had it for 5 years. Do I just hang on to it? Or is there something that I can do in terms of tending my portfolio, cropping the week or cutting out the week in order to allow the strong properties to come through and to reorganize that portfolio? Andrew, you do a lot of this. Talk to us about this.
So there's a couple of points that just jumped into my mind when you were reading that. And I would do reviews with investors all the time. And often when someone says it's not going according to plan, they've either not bought right and didn't have a proper plan in place at the start. And so if you are buying well, you can buy and hold forever, pretty much. You should be able to get 15, 20 years out of a property. It shouldn't be an issue before you have to sell something. But let's face it, sometimes we make mistakes. Andrew Nicol has. And one thing, though, I wonder in this scenario is whether or not someone's bought something, so they bought it 5 years ago. That makes me think, okay, previously they were getting a tax rebate based on any losses they were making, and so probably the cash flow might not be as good as what they were expecting. The other thing is, if you're looking at a 5 year, and unless you're buying in Wellington in the last 5 years, you probably haven't had massive amounts of growth. And people often, we work out, say, a growth is 5% per year on average, but that's a 15-year average. It's not a 5-year average. And it could very well be, if you'd bought in Wellington, 13 years ago, you were about to get 8 years of a flat market. And so 5 years on, you go, oh, God, I'm topping up this rental property by $50 a week and it hasn't gone up in value. I'm just going to sell it and get off. And then you get off that market and then a couple more years tick by and then the market goes berserk and someone else gets all those gains that you paid $50 a week to miss out on. And so I think it's really important that whilst you review your portfolio on an annual basis, the main thing you need to be looking for is cash flow, because cash flow is king. It doesn't matter if a market's not performing this year if the cash flow is good, because you can afford to hold it. And you need to look at your portfolio as a whole. It's okay to have a property in Auckland costing you $150 a week if then you've got a property in Christchurch paying you $50 a week, a property in Hamilton paying you $50 a week, and you're topping up $50 in total and it's affordable. You need to look at the overall picture. Now, one thing that I'm noticing at the moment is that a huge number of mortgages are coming off their fixed rate. So I often talk with investors, and if cash flow is an issue because of ring fencing or because maybe rents haven't gone up as quick as they'd like, then we look at whether or not they can reduce their largest cost, which is most often their mortgage. So by rejigging the mortgage, and sometimes you pay a break fee just to exit that contract early and fix on a lower rate. At the time of this recording, I just read an article to hear that rates now in New Zealand at one bank are available at 1.99%. I think it was Heartland Bank.
That's correct. We'll just talk about that because it is so good. So what Heartland Bank have come out and said is they are offering a 1 year fixed rate of 1.99%. So ridiculously low. Their 2 year rate's 2.35 and the 3 year is 2.45. But this is a digital only offering. So what they've done is they've found a way to cut out a whole heap of people in the process so that they can offer that discount. Now, what that probably means, though, is that if you're applying it for this mortgage yourself, you're probably not using a mortgage broker, which means Correct. You're potentially foregoing some of that structural advice. The reason I'm really excited about this, though, is that it adds some additional price competition into the market. So over the next few weeks, keep your eyes peeled because we may start to see lower interest rates offered by the retail banks. I don't think it'll be 1.99, but it'll be low.
The carded rate, so the advertised rate, probably won't be 1.99 until next year, in my opinion. But what you will see behind the scenes is bank discounting for deals that they want on their books. So strong investors will likely get somewhere around that 1.99 because of this price competition. So yeah, if you can review your largest cost and bring your interest rate down, and we actually had Cameron Baggery speak at an event that we hosted last week, and he was saying that 50% of mortgages come up for renewal in the next coming months or something like that, or next year maybe, and that's huge because most people fix for a couple of years, and a couple of years ago rates were kind of 4.5 maybe for a lot of people for 2 years. So you're going to see those rates drop by half, and so their personal mortgage is costing them less. Their investment mortgages are probably cash flow positive if they've owned a property for a couple of years now. So that's the first thing to do. The other thing is look at what your expenses are that are going out. And the big one here is always going to be maintenance. Do you have a maintenance heavy property? Because if you do, then maybe you need to be thinking about, geez, if I have to replace that roof and then the driveway needs repairing next year and there's a leak or something like that, maybe that's the kind of property you want to get rid of. The other thing is, sometimes people buy properties where the income is pretty capped, so you might buy in a massive complex where there's always 4 properties for rent at the same time, and so there's a lot of competition, so you can't put your rent up any more than the other guys, and so those might be the ones that you want to get rid of. Another thing is, and we've spoken about this before, anything that has kind of bank-specific LVR criteria, so small apartments, hotel investments, those kind of things, if the banks are giving you a smaller LVR and it's stopping you being able to buy multiple properties because you've got 40% tied up rather than 20%, maybe get rid of it. The other thing is low or no growth. Now, again, my disclaimer there is over the long term. If you own in one of the major centres, you just kind of got to suck it up and make sure the cash flow isn't costing you. If you've got something in Greymouth, for example, then okay, maybe that's one that there's not going to be any major growth in the next wee while, so bite the bullet and get rid of it. And I just want to talk about a couple of case studies. So 2 investors who, one I advised to sell and the other I advised to keep. So one of my investors, it was a Christchurch investor, they own several rental properties. They were going to sell one because their cash flow wasn't great because of, again, ring fencing, and also they'd gone down to one income. So what we did in that case is we looked at the cost to break the mortgage, and it was pretty nominal. I think it was about $10,000 across their portfolio. That $10,000 is tax deductible, as is the interest on the mortgage that they took out to get that. It's dropped their interest rate down so drastically that now they're generating so much of a surplus that they're paying their own mortgage down by $15,000 extra a year from that extra cash flow. So in that case, I said absolutely keep. The other clients that I'm working with said the opposite advice, sell, because they owned an old property in a good location, but they were really limited around the rent because it was rented out to a family member. Even on the open market, because of the old style of this house, and it was, damp and all those kind of things, when there's a lot of new houses around it, they were really going to struggle to get optimum bang for buck. So in their case, they're selling, and they were actually able to buy 3 properties, which is costing them less per week than that one.
The other case study I want to talk about is one of our property partners, Scotty, was just working with some investors up in Auckland. These investors were later on in life, 62, 65, with 3 investment properties, all freehold, so no mortgages. And at that point, that's where you would start to review your portfolio and say, okay, we've got no mortgage on these, we've got a lot of equity, but we're later on in life, so let's start moving and trading one property that's perhaps a standalone house, maybe great growth property, not a good yield property, and actually start moving to something like a room-by-room rental, dual key apartment, standard apartment, something that's going to get a much better rental yield as you move into that retirement stage of life. They don't want to be buying another growth property now, like a standalone house, because by the time that it starts to appreciate in value over a 15, 20-year period, then they're going to be 85, for instance, and so they're not going to be able to enjoy the benefits of it. So that's where you might start to change the properties you're holding based on what your new requirements are.
Yes, and that actually just reminds me of another client. It's actually the parents of the investor that I told to sell their property. So we're looking at their portfolio as well, and they're in a similar position, and we need to supplement retirement income. And so what they're doing now is going to sell one in Auckland, buy 2 high-yielding properties. They're also going to try and buy a growth property, hold on to that for maybe 10 years, sell that, and then pay off the small level of debt that we're going to get against those yield properties.
Now, to answer the question from this investor that they've sent through, yes, review your portfolio every year is what we're saying, but specifically have that focus on cash flow. How can you improve the cash flow? So the question I've got for you, Andrew, is that under the new RTA, the Residential Tenancies Act, investors now only have the ability to increase rent every 12 months. Are you putting up the rent on your properties every 12 months?
So I review my rent every 12 months anyway. And actually a client of mine asked me today about this, but most leases that I would sign are for 12 months, so I'm never really increasing them during that term, even though previously you've had the right to. But if I have a tenant renew, I might only do a $10 increase or a $20 increase and know that not having 3 weeks of vacancy balances out and I still get more money.
Yes, but you're consistently putting it up by a little bit when you can and as the market allows.
Absolutely.
And are you making that call, or are you letting the property manager make that call?
I would never make that call myself because I'm not actively in that market. I just have professionals to do that.
And Mickey, just before we hit record, you mentioned that you had a really great case study around this of people who are reviewing their portfolio. Walk us through that.
Yes, Ed. So I had some investors, and this would have been about 6 weeks ago. So I sat down with them and they said, hey, look, Mickey, we really need a plan of attack. We purchased an investment property off a friend of ours in 2018. And realistically, we actually didn't really get a lot of advice when we purchased it. It seemed like a solid enough house. It seemed like a good deal. So we went ahead with it. We had some spare cash at that point in time. But when we've sat down with a financial advisor, is we've found that this is actually really crippling what we're trying to do moving forward. We actually need a larger family home, and this is stopping us from doing that. So I had a look at it. I did a CMA, a market appraisal for them, and I found that in fact the property hadn't really increased in value at all in the last 2 years. And there's a couple of factors for that. When they purchased it, it was pretty run down, and I actually think they paid too much, to be frank with you. So
good friends stitching them into that deal.
Yeah, exactly. So we put a bit of a plan together. We tidied it up. The tenants were at the end of their lease, so they moved on. We put some stage furniture and managed to get it sold with them. Now, hey, look, they made a little bit of money off it. We're talking $5,000 or $10,000. So realistically, for 2 years of supplementing that mortgage,
it's probably not been worth it,
and dealing with the trials and tribulations of an older property, it wasn't a great decision. So all I would say to wrap up on that is to really seek advice when you're looking to make a financial decision, and without pumping them up too much. Opus are really, really good at facilitating that side of things and giving people really, really good advice.
You can take the gun away from his head.
Thanks.
And actually that just goes to my point that because this is a long-term investment, you really have to have long-term vision when you're planning out if it's the right time and the right property for you. Yes. You need to think about those things like, are we going to have to change our house? Is this going to affect us? And those maybe shouldn't stop you investing, but they need to be considered because otherwise if you do only hold a property for 2-3 years, you're not going to make money. You need to be doing this for the long term and have the foundation right before you invest.
But in the instance with that case study as well, Mickey, the benefit of what those people deciding to sell and move on is that they can redeploy that capital, that deposit, into a better investment once they've decided that. Now, you don't want to do that because you never want to be in the position in the first place where you need to be able to do that, but that is the benefit. I mean, they may have only made 5 to 10K after real estate agents' fees, but they can redeploy that capital, and that's the important thing there as well.
Absolutely, and that's what I said to them. Hey, once I've purchased their newer home and sold their smaller one, that's when we say, hey, look, let's get back to the rental market and let's secure something that's going to pay them a decent yield or possibly have that future growth that they desire.
And it just reminds me, you need to actually take action when something isn't performing as well. Whilst not act in haste, you do need to take action. It reminds me of a story by one of my favourite authors, Tim Ferriss, who wrote The 4-Hour Workweek, who's a fitness fanatic. And he was telling me from the pages,
good friend of yours,
about a time that he made a cheesecake, and he's so into health that he used this kind of stuff like stevia, and he read it wrong and put so much in there that it was so terrible to eat, but he sat there and ate the whole thing. and afterwards, his message was, look, sometimes you just make mistakes. Own them, don't eat them.
Fantastic. Let's wrap it up there. But please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you want to learn more about Property with Andrew and I, come along to our free in-person Property Academy podcast live events. These are happening next week. It's happening on Tuesday, it's happening on Wednesday, and it's happening on Thursday in Christchurch, Wellington, and Auckland. You know what to do. opuspartners.co.nz/pod event to register for your free ticket. Thanks for listening to the Property Academy podcast. I'm your host, Epic Knight.
And I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.